And we may think that the gold rally has started, but really, if we look at gold relative to other commodities, it has not. We are at levels that we were at the end of the bear market in 2015. This is just a commodity rally across the board. Wait until there's a gold and silver rally specifically, and then we'll see gold and silver really take off relative to other commodities, which we have not seen yet.
Prepare to navigate the market's ebbs and flows with Rafi Farber's newest video update. Gold has surged past the $2,200 mark, paving the way for an exhilarating journey ahead. But hold on tight, because there's more to come. We're currently experiencing an unprecedented commodity rally, with silver rapidly gaining ground and other sectors jumping on board. Join us as we delve into the intricacies of the market. Buckle up for an immersive exploration of the financial world. It's time to decipher the chaos and uncover opportunities.
So we got some short covering in GLD, about 500,000 ounces, 500,000 ounces short covering in GLD shares, specifically not in the futures market, but in the ETF. And I will show you how I know this. Silver premiums are finally down to pre-silver squeeze levels, or not exactly pre-silver squeeze levels, but normal levels that do not indicate any specific demand for physical silver by stackers or any stress in the physical markets, which indicates to me that the stackers are asleep at the wheel and nobody is believing this rally. They do not trust it, which means there is a lot of room to go in here. The proverbial wall of worry, the silver wall of worry in this case. We are at a critical level of open interest in gold for the hedge funds. The managed money longs and the COT reports are at the bullish bearish line going back to 2008, which means if we can sustain this level of open interest in managed money longs and hedge funds longs, that means probably we are in the beginning of a sustained bull market in gold. And of course, silver will follow, though it will lag in time. It will overtake gold in the end at the end of the run. It's going to go quickly, as it always does. We're going to take a look at cocoa because there is a major short squeeze in cocoa as a preview of what will happen in the gold and silver market. And of course, when there is a short squeeze, a real short squeeze in gold and silver, that means the dollar is dying in its last throes. Yen, deep unchi. I looked up unchi. It means excrement in Japanese. I'm not sure if I'm pronouncing that correctly or if I'm using the correct idiomatic term or whatever it is. I'm going to show you a serious mistake made by trading economics that you got to watch out for, because it's not just that they're trying to confuse you. I really think some of them are that stupid and they should really fix this mistake before they look really, really dumb. And we may think that the gold rally has started, but really, if we look at gold relative to other commodities, it has not. We are at levels that we were at the end of the bear market in 2015. This is just a commodity rally across the board. Wait until there's a gold and silver rally specifically, and then we'll see gold and silver really take off relative to other commodities, which we have not seen yet. And finally, mining stocks are in a perfect triangle going back to 2016, and that triangle is going to break out, and I believe it will be to the upside. And speaking of mining stocks, this silver report. So first slide here, we have some short covering in GLD on March 17th. I'll use these charts to explain how I see that, how I know that. I don't know it for sure, but it really looks that way, and I'll explain to you why I think it looks that way. So we have here a chart of gold shares, GLD shares. This is not futures. This is the ETF, specifically GLD, no other ETFs. This is only GLD. So we have the total metal in the trust, and we have a huge influx of gold here, about 500,000 ounces. This is from the day after. This is 0.05 million, so that's 50,000 ounces, but the day before was 500,000 ounces. This blue line here going up, and the gold stocks increasing in the ETF. So we see here that a lot of gold went in, but what do we see on the next chart? So that is transparent gold holdings, total transparent gold holdings in all gold funds across the board that we know about. On that same day, March 17th, this circle here, we see the bar was about 450,000 ounces or so. So all of maybe 430, it's hard to eyeball it. It's whatever, it's less than 500,000. So we had 500,000 ounces in on GLD, but only 450,000 ounces in on the same day across all gold funds, including GLD. So that means all the other funds, including the ETFs, including COMEX, including all the paper funds, unallocated, allocated, whatever, taking that all into account, gold only flowed into these funds to the tune of 440,000 ounces. If you take away GLD, gold holdings were down about 50,000 ounces, excluding GLD, which means the only one that flowed in was GLD. It looks to me that there was a whole big short position in GLD that was being covered. And when you cover a short position in GLD, you have to put gold back in, especially if you are doing in a basket size, which you would if it's 500,000 ounces. If this were retail demand in gold funds, we would have seen other ETFs and other gold funds increase holdings. We did not see that. So I assume this is short covering. If it's short covering at a loss because GLD is at an all-time high. Premiums finally down to normal levels. It's a discouraging sign, but it's also an encouraging sign because it means that there's a lot of fuel left to fuel this market because the stackers are not participating in this yet. So I have here the red line of where premiums have been historically. This is where we are now, 10.67%. This is junk silver coins. And we have here, this is the same premiums we were at during the 2014, 2015 near bear market bottom in the silver market. And it was the same around here in 2021, just around when silver squeeze started, but before it started to really take off. This is interesting here. We have a history of managed money longs. This is the COT charts. I put a bunch of rectangles here. I'll explain in a second. So we have here on the top here the gold price in US dollars, and on the bottom we have gold, COMEX gold futures managed money long positions minus COMEX gold futures managed money short positions. So basically the net position, the net long position, net long or short position by the managed money, by the hedge funds. So we see here these rectangles, okay? This is where we are now, 141,000 contracts. This is historically high. It's high, but it's not historically high. And we see here in the first rectangle, we were consistently above this level here, just above this level, and this was like the support level for open interest in the managed money. So this is basically how much hedge funds are long gold, how much they're speculating. So we saw here from about 2009 to 2011, during the gold top in 2011, we were consistently above this number, which meant a persistent bull market. This was a huge gold rally. And here at the top here in 2012, when the bear market really started, we just got up to the level, but we didn't quite break it. And now here we see the bear market. We were consistently below this level in open interest for the managed money longs, for the hedge fund speculative long positions, to about 2011 in the gold top, September 2011. And we should see a very similar price action to what we saw in 2009, 2011, but I think it's going to be more extreme because the dollar is in a much more precarious position than it was back then. So I just wanted to go over this chart. This is the gold relative to the CRB index. Look at this. So everybody thinks we're in a gold rally. Oh, not really. We're in a commodity rally. This is a commodity across the board rally, because if it was a gold rally specifically, gold would be outperforming commodities, but it isn't. This is the gold to commodity ratio. So we see we're at the same number here as we were in 2023, the same number we were here in 2020, just prior to the all-time high when oil went to like negative $35 a barrel. And we're at the same numbers here as we were in early 2016 when the bear market ended. So no, we're not in a gold rally yet. In dollar terms, yes, but in commodity terms, no. Just wait until we're in a gold rally in commodity terms and dollar terms. That will mean the dollar is dying. And mining stocks, going back to Fortuna Silver Mines, our sponsor, FSM, for this week's Silver Report. Mining stocks are in a perfect triangle that looks about to blow out or break higher. The higher this is, the higher that gold stocks are relative to the gold price. We've been in an ascending triangle since the bear market bottom at the end of 2015 here. We're going to break out of this triangle right now. I don't know for sure if it's going to be right now, but we're testing it again here for the the fourth time here since 2020. It's going to break out. It's going to break out to the upside. And when it does, gold and silver stocks are going to zoom. And this is not advice.
Before we conclude, make sure to tap that like button if you found this video enlightening, and hit the subscribe button to stay updated on future market analyses and financial escapades. Don't overlook the notification bell to ensure you never miss out on our latest content. Keep those comments flowing. We value your feedback. Until next time, may your trades yield profit and your investments thrive. Stay savvy, stay sharp, and continue conquering the financial world, one trade at a time.